Rohr here with an early concise highlight on Wednesday, May 6th, 2015. It is currently 7:30 a.m. U.S. Central Time, and we're coming to you a bit later than usual because we wanted to see the ADP, U.S. ADP employment number this morning. We'll discuss that shortly. And also, this is going to be concise because the foreign exchange remains substantially the same as yesterday's extensive view, and all the market observations that were written up after the close yesterday below the trend view video. And even though the dollar's under some pressure again from that weak ADP number this morning, it is still within the bounds of the lows seen last week and therefore still consistent with yesterday's view. So, what does all this mean to the markets? And on current form, we've got the S&P 500 hourly chart on the left, 30-minute on the right as usual. And you can see the drubbing the market took yesterday after gapping up on Monday. We covered this in yesterday's video as well. We'll be brief. Back up to the downside reversal from last week Monday when it set a new all-time high at 21.19 above the old 21.17, but closed back below the previous Friday's 211.70, and ultimately the tolerance was 21.14.50. Lo and behold, even with the big recovery last Friday into a gap higher on Monday, 21.14.50 tolerance stopped the bulls. Market was steady, stagnant, and yesterday morning opening up down at 21.05, kicked back up to around 21.09 early, but immediately came under pressure back below Friday's close, 21.0160, and once it did, couldn't get back above it. Now this led to serial failures yesterday on a short-term view, admittedly, at 20.97, and then even as across time ground its way down below 20.90 to 88. However, on current form, the market is up 5 today, right back into 20.89. Now it's going to be very important early today where there's a minor bounce back to that key over-under area from previous, and also back around the gap that the market left on the way back up last Friday and held on the minor dip mid-morning before pushing up again and gets back above 2090. If it does, the other key factor is that will then diffuse a market that's gone from an upside runaway condition above the upper runaway band on the gap higher Monday into a very weakened state, escaping the lower runaway band that it just crossed back below yesterday morning by yesterday afternoon. If it can get back above 2090, then it may at least push back up 2097 to 2100, but most importantly, settle into a bit more of a trading market instead of a weak market as it sees 30-minute and hourly MACD get back above these lower runaway bands. If it stays weak, we suspect another drop down to the 2078 to 75 area, very important on current Fibonacci, even with the new high that only pulled this Fibonacci level up to 2075. And you're looking at, again, as we've suggested, a sideways, choppy, erratically chopping market. But notice how, after the gap up from the Friday close, when the market took the pressure back on the 17th, recovered from right around the from below 2075 to 78 to close right at that area, gapped up on Monday the 20th. On the way back down last Thursday, once it got weak, it filled that gap once again. So we're reasonably confident if you can't get above 2090, you probably end up back down testing something like 2078 to 75 once again, with lower extended supports in the 2060 to 58 and 2040 to 36. And that pretty much does it. Looking at that key level, that if it even gets above 2090, can it really get back above 2096 to 2097 again? And we shall see. That pretty much does it for the short-term view of the S&P 500.